ESG considerations have become a huge topic in the financial world, so we see some new terms in this domain too. Sustainable finance is an approach that integrates environmental, social, and governance considerations into the investment decisions. Green financing is a bit more focused on environmentally conscious investments, but sometimes it is used interchangeably with sustainable finance. Similarly, SRI is an investment approach that aims positive or neutral impact in environmental or social issues alongside positive financial return. There are different ways to include sustainability in financial decisions. A fund manager can use one or more of these ways while constructing their portfolio. Impact investing is the one we hear most about. Another method is negative screening. It is simply exclusion of certain companies based on their industry or ESG performance. Positive screening, on the opposite side, is investing in companies which have higher ESG performance compared to their peers. Thematic investment, for example, is a method that seeks much more direct involvement with sustainable development. For this type of investment, the company must be operating in one of the sustainability themes. So the companies, the investee companies' raison d'être should be directly linked to one of the sustainable development goals, such as manufacturing solar panels or a project that creates equal education opportunities in underprivileged zones for women or for children. And as a last slide, we have 4 examples of investment products. SIN stocks are shares of the companies that operate in so-called SIN industries, and they are gambling, tobacco, alcohol, weapon manufacturing, and adult entertainment. These are the ones that are subject to negative screening based on values, because a fund manager's philosophy or an investor's philosophy might be contradictory to these industries, and they are excluded from portfolios. Stranded assets are the assets that suffer premature write-downs, and a good example is fossil fuels, because of the huge discussions around carbon emissions and all other possible regulations, potential regulations that we might see in the future. And on the opposite side, a green fund invests its assets in sectors and activities that benefit the environment. And fixed income instrument, a positive environmental fixed income instrument, is called the green bonds. And their primary aim is to support environmental projects. Certainly, there are many more terms which we have not covered in this webinar. Each of these subdomains have their own specific jargons, but for an introductory view, we hope this presentation is helpful. If you like this webinar, you might want to follow Ascentys ESG on LinkedIn and Twitter, as we will continue sharing ESG content in quick bites. Hoping to meet you in another webinar. Thank you.